from Kenya to Colombia, from Iraq to Korea, in slums, in schools, in prisons, and in theatres. Every day, people gather at TEDx events around the world to hear the best ideas bubbling up in their communities. Today, you are part of a global conversation about our shared future. So what is this TEDx? TEDx is an initiative of the TED Conference, a non-profit devoted to ideas worth spreading. We grant free licenses to allow TED-like events to spread globally. This event today is based on the TED Conference format and ideals, but is independently organized by your local community. So please make sure to thank the team of volunteers who worked so hard on today's event. It's their ideas, dedication, and time that made it all possible. It's they who booked all the speakers, and the views you'll hear today are, of course, those of those speakers, not necessarily of TEDs. But we hope their talks spark an exciting conversation among you. This is a day for curiosity and for skepticism, for openness and for critical thinking, for inspiration and for action. The more you enter into it, the more you'll take out. And now, on with the show.
Assalamualaikum warahmatullahi wabarakatuh to Dr. Siti Haliza and my fellow classmates, and welcome to our TED Talk. So, our today's topic is about the new Mfrs, Mpers, and Mpsas. I hope you guys enjoy this TED Talk, and you guys will be able to gain new knowledge once this TED Talk ends. So, our TED Talk will be having 3 sessions. For the first session is about the Mfrs and will be led by me, Muhammad Mustafa. For the second session is about Mpers that will be led by Cik Muhammad Khairul Anwar. And for the last session of this TED Talk is about Mpsas and will be led by Muhammad Daniel Asfar. So, without delay, I would like to start this TED Talk. So, we will start our first session with Introduction to Mfrs Framework. The Malaysian Financial Reporting Framework inculcates 3 prime areas, which are the Malaysian Financial Reporting Standard MFRS, International Committee Interpretation, IC Interpretation, and lastly, Conceptual Framework for Financial Reporting, which is Conceptual Framework. The Malaysian Financial Reporting Standard MFRS Framework was introduced by the Malaysian Accounting Standard Board, MASB, and came into effect on 1 January 2012. It is fully compliant with the International Financial Reporting Standard IFRS Framework, which enhanced the credibility and transparency of financial reporting in Malaysia. The adoption of the MFRS was a significant milestone for the capital market. Entities can now assert that their financial statements are in full compliance with the IFRS. Entities other than private entities shall apply the MFRS framework for annual periods beginning on or after 1 January 2012. The exception of entities that are permitted in the alternative to apply the Financial Reporting Standard FRS framework. There are 42 standards covering all relevant areas of MFRS. People are asking what is the purpose of MFRS. So as you know, MFRS plays an important role in ensuring an entity's first MFRS financial statement and its interim financial report for part of the covered by those financial statements contain high quality information that is transparent for users and comparable over all periods presented. It also provides a suitable starting point for accounting in accordance period with Malaysian Financial Reporting Standard MFRS, as well as be generating at a cost that does not exceed the benefits. Next is how the MFRS introduced in Malaysia chronologically. So, firstly, on 1 January 2005, MASB has renamed all its existing standards as Financial Reporting Standard FRS. The numbering of the FRS corresponding to the IFRS issued by the IASB. For example, FRS 1 in Malaysia is equivalent to IFRS 1. FRS with a 100 prefix corresponding to its equivalent IAS. Thus, FRS 101 is equivalent to IAS 1. FRS with a 200 prefix denotes locally developed standard with no equivalent international standard. On 1 August 2008, the Financial Reporting Foundation, which oversees the operation of MASB, and MASB issued statement on their plan for full convergence of Mfrs with IFRS as issued by IASB by 1 January 2012. On 17 November 2011, the MASB issued a new MASB approved accounting framework, the Malaysian Financial Reporting Standard (Mfrs) framework, which is a fully compliance with IFRS framework and equivalent to IFRS. The Mfrs framework comprises standards as issued by the International Accounting Standard Board (IASB) that are effective on 1 January 2012. It also comprises new and revised standards recently issued by the IASB that will be effective after 1 January 2012, such as Standard on Financial Instrument, Consolidation, Joint Arrangement, Fair Value Measurement, and Employee Benefit, among others. The adoption of Mfrs framework allows Malaysian entities to be able to assert that their financial statements are full compliant with IFRS. There are a lot of advantages if companies comply with the Mfrs framework. Firstly, it improves the access to foreign capital. With IFRS, in order to obtain greater exposure to the new financial market, anticipation of improved communication with information users is also reported to be one of the motivation helps firms to supply information that meet foreign investors' needs to use IFRS. Next, it enhances the quality of reporting. A study shows that IFRS adoption increased the firm's financial reporting quality. Next, enhance the comparability of financial statement. Research found that most of the respondents who are an accountant or auditors perceive that by applying the IFRS, it would lead to greater comparability of financial performance, followed by greater relevance, reliability, and transparency of financial information of companies. And lastly, attain international marketability. Extra training for local staff is not needed. If everything is already conforming to international accepted standards, and those who understand and implement this accounting standard, it would, in terms of career, almost immediately attain the international marketability. Mfrs is still new in Malaysia. There must be challenging for the companies owner to adapt with the adoption of the Mfrs framework in their organization. So, these are some challenges that might be faced by the company's owner in adapting with the adoption of the Mfrs framework. So, firstly, the new FRS would result in greater volatility in company results. This is due to the adoption of the fair value accounting in business combinations, share-based payments, asset held for sale, and equity and debt investment in the new FRS regime. Thus, it will introduce significant volatility in the balance sheet and also in earnings. Next, the new FRS would also result in changes in the presentation of financial statement. This is because the new FRS will bring the new rules on recognition and valuation of assets. Besides, certain off-balance sheet items like derivative, leases, and asset-backed securitization will be brought onto the balance sheet. Next, the introduction of the new FRS may involve higher costs. The relative implementation costs will be even larger for smaller companies. As there are fewer potential users of the financial information disclosed by a small firm, this would result in fewer potential benefits and higher accounting costs per users. And lastly, the complex nature of some of the IFRS. Based on the data collected by the largest international accounting firms during their 2002 Convergence survey, one of the most significant impediments to convergence appeared to be the complicated nature of particular IFRS. When some companies try to implement the Mfrs framework in their company, there must be slight issue happen in their company. So, there was an issue occurred when Mfrs 16 was implemented. For your information, Mfrs 16, which is the new accounting standard for leases, is superseded the old standard which is Mfrs 117. The standard has impacted the profitability of companies, especially those in the retail, airline, and services sector that rely heavily on leases. Proof of this lies in the financial performance of their companies. For example, AirAsia X Berhad, Berjaya Food Berhad, and Media Prima Berhad. Mfrs 16 is no longer a distinction between finance and operating leases for lease accounting, as was the case under Mfrs 117. For audience information, in a finance lease, ownership of a property is transferred to the lessee at the end of the lease term, but in an operating lease, the ownership of the property is retained during and after the lease term by the lessor. Under Mfrs 117, operating leases were expensed in the profit or loss statement and kept off the balance sheet. Only finance leases were recognized on the balance sheets. However, under Mfrs 16, a right of use approach is applied, which requires a lessee to recognize assets and liabilities for the rights and obligations created by lease contracts. By bringing asset and corresponding lease liabilities that were previously off balance sheet onto the balance sheet, entails higher depreciation and finance charge in the profit or loss statement of the companies that were previously unaccounted for, thus eroding the profitability of the companies. Mfrs 16 may also impact the outcome of valuations and introduce new attention areas in business valuation and mergers and acquisitions. Although equity value should not change, the enterprise values of companies are expected to increase as a result of higher earnings before interest, tax depreciation and amortization, EBITDA, and higher net present value of free cash flow. One of the companies that affected by this implementation is AirAsia X. The company net loss widened 16.4% for 3 months due to the higher depreciation and finance cost charge as a result of the implementation of Mfrs 16. Two of the big retailers also affected by this implementation, which are Starbucks Malaysia and Brunei operatives Berjaya Food. But judging from the slew of financial scandals, which are becoming more complex by the year, from Enron almost 20 years ago to our Malaysian 1MDB Berhad today, any calls for more disclosure and transparency will do more goods than harm for corporate governance. I think that's all for me regarding the Mfrs. The advantages and challenges I take from the article written by Morni Hayati Jaafar Siddiq and Rahiza Abdul Rahim titled The Benefit and Challenges of Financial Reporting Standard in Malaysia, Accounting Practitioners' Perception. So if you want to know more about it, you can check the article out. And if you want to know more regarding the case about Mfrs 16, you can read the article from The Age, published on December 5th, 2019, titled Cover Story Mfrs 16, Short-Term Pain, Long-Term Game. So, thank you for lending me your ears. We can continue with the second session of this TED Talk.
Hi, Assalamualaikum warahmatullahi wabarakatuh. My name is Cik Muhammad Khair Anwar bin Ashif. So now, I will give a talk about Mpers. What is Mpers? Mpers is Malaysian Private Entities Reporting Standard. But, before that, allow me to introduce you with my assistant.
Hi Dr. Siti and everyone. My name is Mpers and I am Khairul's assistant for today. Nice to meet you all.
For the introduction, Malaysian Private Entities Reporting Standard, which is Mpers, is the accounting standard that is applicable for private entities. Mpers is replaced the existing framework, which is PERS or Private Entities Reporting Standard. Mpers is self-contained standard with 35 sections covering all the relevant areas for financial reporting by private entities. Mpers attempt to meet users' need while balancing the cost and benefit for preparers. So, what is private entities? Let's see the explanation from my assistant.
Hi everyone. What is private entity? Let me explain it to you. So, before I explain about private entities, let me introduce you to the types of company. Generally, there are 4 types of company, which is limited company, unlimited company, public company, and the last one is private company, or as we know as private entities. According to the Companies Act 2016, the private entity is a company which is limited by shares. The company has less than 50 shareholders. Unlike the public traded company, private company do not have public stock offering. In other words, private company is not a PLC or companies related to PLC. PLC is public listed company. The private company are not required to prepare or lodge any financial statement under any laws, and it is administered by Securities Commission Malaysia or Bank Negara Malaysia. The private entity are not a subsidiary or associated, also not a joint control companies. A private entity can be a partnership, cooperation, individuals, non-profit organizations, companies, and other organized groups. So that's our explanation about private entity.
Now you know what is private entities. So we go to the next topic, which is background and history. Malaysian Accounting Standard Board, or MASB, has issued the Private Entities Reporting Standard, or Mpers, in Malaysia for private entities, as it defined in Companies Act 1965. This focus for Mpers is on property needs rather than investor needs. This framework generally prescribes the use of cost model and measurement basis for the private entities. Mpers was effective from 1st July 2007 until it was replaced by the Mpers. In February 2014, MASB issued Mpers, where the company needs to comply this reporting standard starting 1st January 2016. This Mpers set a new milestone for financial reporting of private entities in Malaysia. For your information, Mpers is equivalent to IFRS for SMEs issued by IASB, International Accounting Standard Board, in July 2009. So, on October 2015, MASB issued the amendment for Mpers, which is this amendment also equivalent to amendment of IFRS for SMEs, where it was issued by IASB in May 2015. The amendment make some minor changes to the standard of Mpers, provide more clarification and guidance on the requirement, and align some standard of the Mfrs. This amendment was effective on the 1st January 2017. Next is Mpers was launched by Tan Sri Azlan Zainul, which is the chairman of Financial Reporting Foundation, FRF, and also Datuk Zahrah Abdul Wahab Fenner. Who is he? She is CEO of Suruhanjaya Syarikat Malaysia. This launched program was on 27 October 2015. Next, this new reporting framework is issued by 2014, but it was effective on 1st January 2016. So there is a gap of time, which is 2 years, for private entities to apply or to comply this framework. So it's called application permits. With early application permits, private entities now have a choice whether to continuing with the existing private entities reporting standard or existing Mpers, or to apply the MFRS framework, which is mandatory for non-private entities except the transitioning entities. Or the last choice is, by 1st January 2016, they need to mandatory migration or change to the new Mpers framework. As the requirement of the first time adoption for Mpers it is a retrospective. It is important to private entities to prepare in advance if they have to change to Mpers or Mfrs framework in the future. So the question is, what is retrospective? So let's hear the explanation from my assistant.
What is retrospective? Good question. So, let's hear this explanation from me. So, what do you think when you see this retro car? Yes, it is an old model or previous model. The word retrospective relates to the retro words, which show the past or previous event. For example, in retrospect, I think becoming Kairo's assistant was a bad idea because I don't receive any payment for this. In retrospect means that you are thinking about something in the past or previous with hindsight. What is hindsight? Hindsight is understanding the situation only after it happened. So, this is clear.
So next, let's talk about section 35. MASB issued Mpers to replace the existing accounting standard, which is Mpers. In section 35, it was provided a guidance and it is a useful starting point for the company to follow the new rules for those who are the first timer to change from the current accounting practice to the new accounting requirement or the new framework. It was also aims to ensure that the financial statement published consists of high quality information that is transparent to users and also comparable over all time periods it was presented. There are four main steps in applying Mpers in section 35. The first step is determine whether the entity or the company it is a first timer adopter of Mpers or not. Second step is determine the effective date and date of transitions, which is we explain in the next video. The next step or the third step is prepare the opening statement of financial position as its date of transition. The next step or the last step is prepare financial statement that comply the Mpers, including the required disclosure to explain the effect of the transitioning from the previous financial reporting framework to the Mpers. To facilitate the transitioning, Mpers section 35 have provided optional exemption and mandatory exemption to the requirements for its prospective applications. My assistant will explain about this exception and exemptions.
Hi everyone, it's me again. So now I will explain about mandatory exception and optional exemption. So the first one is mandatory exceptions. There are 6 mandatory exceptions in Mpers, which prohibit retrospective application of Mpers. The exceptions is the recognition of financial assets and liabilities, hedge accounting, use of hindsight in accounting estimates, discontinued operations, measurement of non-controlling interest, and the last one is government loans at below market interest rates, which is 2015 amendments. Next is optional exemptions. To facilitate the transitioning to Mpers, Section 35 of Mpers allows the first-timer adapter to apply any, all, or none of the exemptions from full retrospective application of Mpers. There are 12 exemptions from full retrospective applications of Mpers and 2 other exemptions added from 2015 amendments. So, this is all the 14 exemptions from optional exemptions.
The next is benefit of Mpers. Let me tell you the benefit of Mpers. The first benefit is increasing their reputation and confidence. Mpers will boost the confidence in private entities as the financial statement has been prepared based on high standard quality, which is prepared by IASB or International Accounting Standard Board. Like I said before, Mpers is equivalent to IFRS issued by IASB. The next benefit is easy entrance for larger market. Company have a better chance to expanding their business if they adhere the internationally accepted standard. So, like I said, Mpers is equivalent to IFRS. So, it will accepted or it will acknowledged by the international company also. So, the third benefit is present value statement. In Mpers, financial statement being prepared in a more representative manner and will be widely acknowledged by the global business community. So the last benefit is migration to the new framework will bridge the gap. The private entities account will be closer to the global standards and stakeholders can focus to their resources more on application. So the next topic is the challenges in implementing Mpers. The first challenge is inconsistencies in existing reporting standard. Since the constant changes of conceptual framework, preparers forced to be agile and flexible in order to always in line with the current framework and standard. The next challenge is timely and costly. The implementing the new reporting framework will eventually need a more time and money because there will be an additional cost for the medium sales companies such as training staff, increasing in audit, consultation fees, internal process modification, and the last one is other upgrading accounting systems. So the third challenges is lack of technical knowledge and expertise. Since the limitation of expert, the company has to send their staff to attend the training program and understand the new standards. Technical skills are needed to achieve a higher understanding level among the practitioners. So, the majority emphasize the requirement for relevant professional training as an essential method to cope with the new included standards. So, the last challenges is companies belong to the companies overseas or overseas companies. A lot of company in Malaysia belongs to overseas company, so it is a difficult thing to follow the Malaysian standard or Mpers. If they implementing Mpers, they need to realign to group accounting policies. For reason, companies disclosure increasing the complexity or overload of financing staff. So that's all presentation from me. For your information, all this information are gathered or collected in this website or this article issued by PwC on November 2015. So that's all from me. Thank you.
In this slide, I will share an overview about Mpsas. Mpsas is the financial reporting framework issued by the Accountant General Department, AGD of Malaysia. AGD developed Mpsas from the International Public Sector Accounting Standard, IPSAS, issued by IPASB, an independent standard setting body under IFAC. AGD takes the position to maintain the accounting requirement and original text of IPSAS unless there is a significant public sector issue and local legislation which require Mpsas amend or change certain requirements in IPSAS for local adoption. The users are public sector entities, which are federal, local government, and states, other than government business enterprise (GBE). And lastly, the Mpsas has 36 standards issued by the AGD. And now, I will continue to talk about history and the background of Mpsas. In March 2013, the Ministry of Finance issued a circular to announce the implementation of accrual accounting for all the public sector entities from 2015 and the issuance of Mpsas. This is in accordance with the public sector transformation policy outlined in the new economic model. Through the initiative, the government has targeted to achieve a federal government deficit budget of around 3% by 2015 and near-neutral budget by 2020. By 2016, concerning about the reporting, FSP are required to prepare financial statement in compliance with Section 16, Subsection 1 of the Financial Procedure and comply with the approved equity standard, which is Mpsas. Mpsas is the accounting standard that has to be observed by the public sector accounting entities in Malaysia. It is expected to be applied to FSP in the preparation of financial statement and was encouraged by AGM to follow, which will take effect from January 2017. The AGD developed and published Mpsas, which is applied to their accrual basis of accounting and set out requirements dealing with the transaction and other relevant events in the general purpose financial report. By the end of 2017, it is stated that the all public sector will apply accrual accounting using Mpsas with effect from 1 January 2018. Move to Mpsas is due to the expansion of Malaysia government. This may help to put Malaysia at the same level with other developed countries. Nevertheless, the move is not without its challenges. There are few studies on the challenges of adopting new standard, which is Mpsas. The challenge faced by Federal Statutory Body Malaysia in applying Mpsas under the transitional period is the failure in obtaining the correct opening balance for all accounts, especially asset. This probably will lead to understatement of asset in making sure that the preparation of financial statement are compliant to Mpsas as payment to respect the opening balance for all asset, liability, revenue expenses and equity. This process has forced the accountant involved in government financial reporting to develop proper strategies to ensure successful implementation of accrual-based accounting in the public sector. The second challenge will be the issue in consolidating the financial statement due to the different accounting standard. This matter arises due to the different accounting standard adopted by subsidiary company practice. After considering the opinion by the AGD, the best practice will be further subsidiary to follow the accounting standard used by the holding company. It's only where consolidation can take place effectively. This is because annual reports are regarded as the main medium of disseminating info to stakeholders. Besides, the government also need to make selection on the appropriate accounting policies that are relevant to the local accounting standard that suit their national circumstances and local legislation. Next, the period given by Malaysia government is shorter to implement accrual-based accounting compared to their previous experience from other countries. There is a limited time for the public sector to be fully prepared to implement accrual-based accounting within this short period of time. The government has faced many challenges in terms of creating awareness about accrual-based accounting and action taken to reform the legislative and regulatory structure. In addition, the public sector also need to integrate a new system and improve their skill and knowledge of human resources in implementing accrual-based accounting. Moving on to the last point, Federal Statutory Body might face issue in data availability and completeness in capturing the information to restate their opening balance. This information is required to handle the measurement and evaluation of assets. On the other hand, in updating Mpsas, there may be conflict in implementing the policy set. Those policies should come first with the guidance of the standard. This is because the implementation of accrual-based accounting involves changes to a wide range of information systems, especially in terms of specialist IT skill. Moving on to the advantages of Mpsas. Accrual accounting is the most accepted method of accounting worldwide for the private sector. Increasingly, the public sector is also moving toward accurate accounting, as it helps government to obtain a better picture of the performance of their policies. The first advantages is accurate accounting facilitates better planning, financial management, and decision making in government, as well as robust and accepted way of measuring the economy, efficiency, and effectiveness of public policy. Further, one of the objectives of financial reporting is to allow a correct comparison to be made between different organizations by using the accrual specified for public financial statement. There is increased comparability of public sector and private sector organized. Once returning the comparability of an individual organization on a period-by-period basis. Next is provide sustainability and better measure of policy effect, which will improve the organization efficiency and effectiveness and provide greater accountability, especially to the public, meaning that public will receive information regarding the outcome of decision made by the source decision maker. Accurate accounting can, however, be presented in a format such that non-accountant can understand the key messages. When this is achieved, for example, by the highlighting of key performance indicator, they benefit to the decision maker of the accrual-based accounting is realized. The use of accrual-based accounting also may reduce corruption. As we know before, the public sector in Malaysia implement cash accounting, which doesn't present the most accurate picture of government financial health, nor does it enable decision makers in the public sector to adequately plan for the development, delivery, and maintenance of its service, program, and infrastructure, on which people realize that in turn leads to a breakdown of trust in government. Accurate accounting has none of these weaknesses. As well as providing useful information on assets, it shines a brighter light on liabilities such as pension scheme if its hosts are appearing. Accurate accounting allows government to make decisions to support their goals without burdening future generations with unmanageable debt. The last advantages would be its regulation at a full cost of government service. One of the main objectives of Accountant General Department is to enhance public accountability and transparency by developing a high-quality accounting standard for use by public sector entities in Malaysia in the preparation of general-purpose financial statement. With the adoption of Mpsas, it is likely to strengthen public finance management, leading to better informed assessment of the resource allocation decision made by government, thereby increasing the transparency and accountability. The accountancy profession has an important role to play in the move to accurate accounting in the public sector. The profession can bring its experience of the private sector to assist the implementation of accurate accounting in the public sector. So, let's conclude all my presentation regarding Malaysia Public Sector Accounting Standards. All the informations are collected from this article review written by Nazarina binti Mat Yatim and Mariati binti Hashim. And also, for further detail, you can visit the Accountant website for a well-written article regarding Mpsas. So, that's all from me. Thank you for listening.
There is a lot of differences between these three reporting standards, but due to limitation of time, I will give you one example regarding the treatment of property, plant and equipment or PPE and investor property. So, first of all, the three frameworks are similar in relation to depreciate with no significant differences noted. For implementation, both Mpers and Mfrs have the similar requirement. However, under Mpsas, the entity has to determine whether the asset is cash generating or non-cash generating asset. If the asset is cash generating asset, entity applies the requirement in Mpsas 26 impairment of cash generating asset, which are similar to Mpers and Mfrs, with no significant differences noted. But in other hands, if the asset is non-cash regenerative asset, and the requirement will be changed, which is company will comply or will apply Mpsas 21 implementation of non-generating cash asset. Company should be aware two types of asset, which is cash generating or non-cash generating. Mpsas 16, Mfrs 140 and the section 16 of Mpers have a similar requirement in relation to disclosure of the plant, property and equipment (PPE) and invested property. Both Mpsas 16 and Mfrs 140 have some additional requirement on disclosure compared to a section 16 in Mpers.